It's not necessarily that, to Mike's point, the 25 additional basis points is the straw that breaks the camel's back. It's the idea that Bill Ackman tweeted about not that long ago. It's, well, you want to push rates higher, then watch the outflow of funds from regional banks and into money market accounts and the like, and that just makes people nervous, too.
I think it does, because it also exposes where there could be other risks on the balance sheet, because the more that you have deposits outflow, the banks have to look at their balance sheets and say, where could we have loan troubles? And one of the things that came out of the earnings season this quarter is that banks talked about the need to shrink their balance sheets or reposition their balance sheets. All that points to is slower loan growth going forward, which would likely coincide with much slower economic and thus earnings growth.
Eric, I mean, look, let's be honest. You've been calling more recently for the sort of the sky is going to fall. It's just a matter of when, right? Your conviction has been extremely high that we were going to make a U-turn and go lower. And in fact, we really haven't. Now, maybe this is the start of something today. Maybe tomorrow will be it. But how do you see it now?
Yeah, so I think equities have been extremely resilient, and this is certainly taking longer than we expected. But it doesn't change the fact that as we look at things, right now, we are seeing the economy starting to really slow, very real time as we speak. The job openings, they still remain very high, but this is the second largest decline over 3 months in job openings in the last 20 years. The only bigger time was around COVID. We're seeing consumer credit. Right? Balances are surging. Probably tells you the consumer is weakening. We're seeing tightening standards, et cetera. Even Amazon, right? To think that, so it's not just a goods issue. You look at Amazon, AWS started off the quarter with 11% growth. That would have been unheard of 1 year ago. And it was a sharp deceleration. So this is not just a goods issue. We're seeing this across the economy. Service is very strong, right? Service remains strong. But if you look at the totality of the data, we are slowing. And, one of the things I would say around earnings is that, earnings have,
been better than you thought? I can finish the sentence, too. Been
sure.
Better than you thought?
No, I'm not going to say that because, they've estimates have fallen about 10% over the last 9 months since we've been negative on earnings estimates. Growth this quarter was negative. So, yes, earnings estimates beat by 7%, which is the headline. Earnings growth this quarter was negative. Last quarter was negative. And that was with GDP positive and nominal GDP very positive. And we think that's going to decline and potentially go negative this year. So we think there's significant earnings headwinds also ahead of us.
So, Cameron, how would you respond to that? Do you agree? Earnings, I think it's kind of hard to deny. I mean, they've been better than a lot of people feared.
Yeah.
That's for certain. And like a deceleration is one thing, which we've witnessed on revenue growth for the kinds of companies that Eric was talking about. A cliff dive is another, and we haven't seen that.
Well, the first thing to point out is that even though there have been a lot of beats, the market reaction to those beats has been kind of just a shrug, which tells you mostly for cyclical companies, when cyclical companies beat and raise and the stocks go down, that's usually a reflection that a lot of the good news is already priced in. But then the other challenge we have is that if you go into the back half of the year, you still have a big earnings ramp into the fourth quarter as well as into 2024. So there is optimism baked in, and that optimism shows both margin expansion and revenue staying strong, which means that there's no recession priced into any of that at these levels.
We may, in fact, have expectations that are too high for the back half of the year for earnings and into 24.
Yeah,
the jury's still out on that.
Without a doubt. Now, the 12-month forward has actually curled higher. I think it's mostly because the better-than-expected numbers from the first quarter are kind of flowing through into current quarter estimates. So, without a doubt, it's a prove-it situation for the later part of this year. I do think it has been frustrating for those on kind of both sides of the recession debate because, everything Eric said is correct. Huge drop in job openings and a big surge in layoffs. Yes, outstanding consumer credit is surging, but then you look at it on a longer-term scale, and it's all kind of getting back to the normal range, or it was just so overstated at one point, or so much stronger than the norm, that it's coming back to the pack. So I do think the fact that we have relatively high nominal GDP growth, because inflation is where it is sort of fouling the mechanism a little bit in terms of determining when earnings themselves are falling off.